All right, folks, welcome back to another episode here of Matt Money. Now, before we get kicked off, today's video is going to be about real estate and the real estate aspect of the portfolio. There was a part one and a part two of this review, and I'll kind of put those links in the description below. If you're more interested in, let's say, the stock aspect of things, the individual brokerage account, the Roth aspect of things, feel free to watch part two. If you're more into the more auxiliary sort of platforms like Robinhood or M1, that's in part one. And part three is what we're going to be covering today, which is the real estate aspect of the portfolio. But before that, I just want to catch some folks up on the local highlights. So obviously today, Realty Income Corp reported earnings today. I thought it was a really good call. I listened to it at about 1:30 this afternoon, and then after that, I had some other work calls that I had to do, and then I obviously listened into the Walt Disney Company. For those of you guys that don't know yet, Walt Disney actually suspended the second fiscal quarter dividend. Actually, it's going to be paid, I believe, in July timeframe, and so I think it's about 88 or 87 cents every 6 months or so. So they're going to forego that and wait until next year to actually pay a distribution. I don't know if they're going to defer the payment or if they're straight up just going to skip that payment in total. By the sound of it, makes it sound like they're going to skip it in total. I actually was quite surprised that they actually were going to do that. They had plenty of free cash to pay the dividend. Of course, they had about 1.9 billion in free cash, but the dividend would have cost them about 1.6 or so billion, and so they're going to skip that to make sure that they have liquidity. You can see revenue is actually up year over year, but this could have been due to the Fox acquisition as well. And you can see income all the way down across the board is actually down as well. But this is actually a really good report if you guys are interested. Another cool thing that I'd like to say, some folks are debating, why would you buy Disney right now? Why don't you buy Netflix if you're into streaming? And I think it's a good point. I think you should look at it, but just at a high level, and we'll kind of dig a little bit more into it. At a high level, Disney's year-over-year growth, obviously, they didn't have last year in the first quarter and first half of the year, actually, any sort of business like streaming. Disney Plus is a rather new thing. They did have Hulu, but I guess they kind of considered it something else. They've kind of all merged it under direct-to-consumer businesses now, so you can see the sort of growth that they're seeing in here. At the moment, they have about 70 million users, whether that is addition of Disney Plus, ESPN, and Hulu. So Hulu is about 32. At quarter end, Disney Plus was about 33, and then ESPN was about 8. And that's up from about, 27 last year. So just in that respect, it's over 100% growth. Just from that, obviously, Disney Plus being a huge part of that. And then they did have an additional 20 million people from this to the end of April join. So there's about 54 or 55 million in Disney Plus alone. So even if these numbers remained constant, there's about 90 million subscribers to Disney products, whether that's Disney Plus, ESPN, or Hulu. And I want to compare that to Netflix just briefly. I'm not going to go too much into it, and then we'll hop right into the main aspect of the video. But specifically, if you look at the two companies and the capitalization of both of those companies are around 180 to 190 billion dollars. That's both Netflix and Disney. Disney at the moment has about 90 million subscribers, and you can see that the cost of that revenue that they're kind of bringing in. So whether that's Hulu, where they're bringing in $67, or just the regular Hulu, which is about $12. Then you have Disney Plus and ESPN. They're cheaper products comparatively to, I would say, Netflix, but this is their introductory price, right? So at the moment, Disney has about 90 million subscribers and growing at a substantial rate year over year. And then you have Netflix, which has about 180 million subscribers to date. Both about 180 billion dollar companies, 180 to 190 billion dollar companies. And plus, Disney has a sports network and many other sort of revenue streams from parks, cruise lines, a direct to theater sort of aspect of things, which Netflix does not have. So I honestly think that at the moment, if you were looking specifically on the streaming aspect of things, Disney is a better product, and I think it's an opportunity for folks to buy in, especially today or tomorrow when the market will be down on this due to dividend investors like myself would be selling out. But I personally am bullish in the long term for Disney. I think they have great intellectual products, and so I believe if you are a big believer in streaming, it's actually a really good opportunity for people to buy in. Going into specifically the personal portfolio aspect of things, let's look specifically at real estate. And so real estate in this particular part of the portfolio is going to be about 14%, or about $42,000, not in the billions anymore. We're talking about a personal portfolio here. And in terms of the percentage of the portfolio that is coming, the income that's coming from that, it's about 16%. So about $2 to $2,500 every single year. So about $200 a month or so coming from that. So if you were to kind of put that into perspective, if you were to say buy a house, a $200,000 house, you might have to put 20% down. So that's about $40,000. At the end of the month, you might cash flow $200, which is nice. But one thing that stocks don't let you do versus, I guess, specifically what real estate might let you do is capture depreciation. We'll get into that a little bit as well. And so I guess to show you guys in terms of a pie and a more visual sort of aspect of things, on the right is the value of the real estate aspect of the portfolio. This is 15%. And then in terms of income, this orange slice here, about 16% comparatively to all the other sectors that are in the portfolio. So thinking about it that way, we are getting about $200 a month from that, and I expect that to continue to increase in the future as companies continue to raise dividends as well as distributions continue to get raised. We'll talk about that as well, and I will be continuing to contribute a couple $100 every single month to Fundrise and other things that will continue to increase the real estate portfolio aspect of the portfolio, and potentially actually might do physical real estate as well. So hopefully in the future, you guys will be involved in that. So before we actually dive deep into Fundrise, Cardone Capital, and the actual real estate investment trust that I own, give you guys a quick public service announcement with respect to if it wants to work. For some reason, I'm having trouble with this. Okay, very good. The people that are subscribed to the channel, I appreciate that. Thank you so much. About 3/4 of you guys that are watching, though, have yet to subscribe. It is down or slightly up, actually, from last time. It was about 75%. Now it's currently sitting about 73%. So I appreciate the folks that are continuing to subscribe. Appreciate the continued global exposure that we're getting. Steadily, the countries that are watching are continuing to drain down this US bar, which I think is phenomenal. Canada has always been a close second, and then United Kingdom is good as well. And Germany went away. I don't know why. If you're from Germany, make sure to get all your other friends out there, because Germany used to be third or fourth pretty consistently, and now they've kind of disappeared. So, but we did cross that 6% threshold for ladies. So thanks, ladies. Appreciate it. Hopefully you can share further with some of your other cohorts to make sure that ladies get represented in the YouTube finance community. And I continue to have more and more women asking me questions, whether that's specifically people that I work with or I'm friends with, that actually might be some of this driving growth as well. I've had a couple friends that I have actually shared this with that really appreciated some of that work, because we all potentially work at the same company, and so some of the videos that I make are directed to Fidelity, where we work, so or where we invest our money. So but yeah, if you haven't subscribed, please go ahead and do that, especially if it's your second or third time coming into the channel and watching a video. So excuse me while I sign into my Fundrise here really quick. Did it remember? My cars. All right, we're back. Thank God. Okay. So for those of you guys that have been following this, I have been doing some Fundrise videos for quite some time. So more recently, within the past year or so, I started consistently contributing to Fundrise to get myself to about 137 or 138 bucks a month or whatever. And reason being, relatively quickly, I think I took a quick test and said, hey, how do I get to like $100,000 in my Fundrise accounts that are going to be paying me dividends in the next 15 or 20 years or something like that? And it said, hey, if you kind of get an idea, 5%, 6% return a year, plus any sort of dividends, you could be looking at adding about 138 bucks a month, and that'll get you to 100 grand. And so I was like, you know what? I don't need 138 bucks a month. Let's just add it in here, see how it works. I don't hate Fundrise by any means. In the past, I think they kind of over exaggerated their potential returns. But in the end, I think it's a relatively good platform, especially if you know how to use it and you want to put some more time into it, and especially put more capital into it. I don't put enough capital into it where I want to take so much time. And so I kind of just let it do its thing and basically just take the ownership of the different assets that I can get across the US as I can. So I've been invested now almost going on 3 years into Fundrise, which is kind of cool. You can see it's kind of grown anywhere between 300, close to 300 bucks, I guess, 260 bucks. So about 10% overall, but keep in mind this was about 1,200 bucks little over a year ago. So the portfolio has grown mostly due to contributions, but it is steadily growing every single year. And I think at the moment I'm averaging around 4.5%. And so I think I just got paid a dividend. Is it going to show me on this one? Dividends. So I just got paid a dividend not too long ago in the beginning of April, and it was 26 bucks. So you can see it's been steadily kind of increasing. Originally, when I first put in the $1,000, it was like $15 dividends. Then it kind of dipped down. I don't know if I changed the fund that I was in. I very well could have. And then it's kind of gotten steadily better as I've continued to add funds into the future. And one of the things that I did notice is when you reinvest these dividends, they kind of select the funds that they put them in for you. And so that's kind of a pain. You might not necessarily want to be investing in, say, LA specifically or Washington, D.C. specifically. So it's kind of a shame that they kind of automatically distribute it like that. I wish you could be like, I only want to invest in this fund, you know what I mean? And I think that that could be useful, right? I mean, if like, let's just say 20% of the folks in LA are like, I want to reinvest my money back into LA, and they're supposed to be paying out, let's say $1 million a month, or $1 million a quarter or something like that. That's 200 grand every quarter that they can go and reinvest back into LA properties. You know what I mean? Like that's another potential down payment on another house, or being able to lend that out to somebody, for debt, what have you. I mean, and that's just one quarter, right? I mean, take in mind that that could be rolled up for 4 quarters. That's 800 grand. You could buy a house outright at that point. So I have some pluses and minuses and pros and cons associated with Fundrise. Obviously, one of the pros is I just put the money in and they invest it for me, right? I mean, you do get a decent return. You can structure it however you want. I do supplemental income. I did used to do the supplemental income plus, but I realized I was too growth focused, I think, and it took away a lot of the income. So I think over time, hopefully, the debt that we're kind of distributing will be kind of increasing, following more of the hidden freedom investing sort of mentality, and be able to get a little bit more income from that in the future. So haven't really seen anything negative about Fundrise, although they did mention that at the moment they're going to suspend not dividends, but people being able to withdraw funds. So in the past, investors used to be able to withdraw funds, and within 60 to 90 days, they'd be able to get their funds out. So if I was like, hey, I need my 2,700 bucks, within 60 to 90 days, they basically would like find somebody that is investing 2,700 bucks or a portion of that, and be like, you can have this guy's sort of funds, you know what I mean? Kind of basically offset any sort of like immediate pullouts, right? And so I think with the recent volatility that they're seeing in the market due to what's going on in the global economy, they just said, you know what, we're just going to hold that for a moment. Appreciate that a portion of you guys might need that money, but the rest of the fund, that is perfectly okay. Let's say like 80% of the investors are okay, and they don't need other people kind of pulling out, which would then say have us have to force sale, certain investor properties and assets that we didn't necessarily want to, right? So Overall, relatively excited with it. You can see fees are relatively small, so that's something that you can keep in mind. Overall, all time, we've paid about $2.64 in fees. So keep that in mind. Relatively low, so that's not something you really have to be like, oh my God, fees, fees, fees. But keep in mind, I think some folks might be clicking on my links. So that might give me some free, um, some free fees. But overall, I think it's way less than 1%, which for real estate management is pretty good. So then hopping into the second one here, we have Cardone Capital. So a lot of you guys are pretty furious about this one. I will be blocking out some of my information here, so I appreciate that. But I think I've let some of you guys know that in the April timeframe, we were approached and said, hey, we're going to delay distributions. And so we did have an investor call last week with Grant. And what it is, it's basically an investment in 5 or 6 multifamily apartment complexes based in either Florida, Houston, Texas, Sugar Land, Texas, and a couple other places potentially. And so what this is an accredited fund and a non-accredited fund. We pooled about $150 million together to purchase these 5 large multifamily properties. I mean, we're talking 100 to 350 unit, and I think overall it's like 1,200 units between these 2 funds. And so relatively good properties for sure. And overall cash flow last year was like $18 million or something like that just from these funds alone. So and that was not fully all 5 properties up and running into the fund yet. So relatively cool. I own 0.03% of those properties, those 5 places, so it's pretty nice to see. And basically they said, hey, we don't need the money right now, but in the case where we do, if May gets a little bit crazy, and if June gets a little bit crazier, then we might need to utilize some of that money for liquidity, which I completely understand. And so when the time is appropriate and things kind of go back to normal, they will resume distributions. So I was getting paid about $56 or so every couple months, or every month, sorry, on the dot, on the 15th every single month. And then they basically deferred those payments until things kind of get better. So April, they're about like 96 or 97% collected. And we just did a call, and May looks like it's about, I think they said like 92% collected, but that was as of the 3rd. So it could get a little bit better. Some places were down into like the high 80s. Some places were like 98%. So that does include a little bit of incentive, so like maybe 5% off to be able to basically pay your rent on time. So folks, instead of being like, hey, we need to get some forbearance or something like that, or not pay rent this month, they say, hey, you pay your rent this month, we'll give you 5% off. I would much rather take that and get 95% of the income coming in, or the revenues coming in, and take that out of my cash flow than have to worry about people trying to take advantage of what the government might be offering. And I'm not saying that everyone is going to do that. I just think that some people, I've heard of some stories being like, well, I'm going to take what the government can give me at the moment. Maybe I can, avoid having to pay rent for 2 to 3 months and never have to pay it back. So I have heard stories on both ends. And of course, if you need that, you've gotten furloughed, absolutely, no harm in you taking that sort of benefit. But I have heard people, not needing to take that sort of benefit, people like myself that are still, have a 9 to 5 job and are still doing okay, just taking advantage of that for the time being, just because the opportunity is there. So understandable that he is offering some sort of incentive for people to pay early, but the hope is by July timeframe, distributions can continue, and if things do get better, my basically 3 months of delayed payments will be paid back to me. So July might be a big month. It could be like a $200 distribution or a $250 distribution. And also, hopefully, once we kind of get more cash under our belts, we will potentially raise the amount of distributions that are kind of coming out. I think they've been kind of limited at the moment, just based off the fact that they're trying to build up cash reserves. So I think they have about $22 million in cash reserves out of the $150 million that we invested. And then they had our $2.4 million that they were supposed to distribute to not only the Cardone Equity Fund 4 and 5 that we invested in combined, but the other Cardone Equity funds and Cardone Capital funds that are there as well. So I think Ours was about 1.2 million, and the remaining 1.2 was associated with other properties. So um, anyway, that's that. So it's about 15,000 invested in that. Should be about $675 in cash flow every single year. So we'll see if we meet that in 2020. And so yeah, and then kind of getting to the next piece here, specifically the real estate investment trust. So what we did already mention to you guys is obviously Fundrise and the Cardone equity piece. But I don't know if I mentioned earlier in the video that we're making around for the next 12 months about $14,500 in income in general from these sort of investments, of which I think I did mention the 2,300 or 2,200 that is coming specifically from real estate, which I think is like 41,000 or so invested. If we just quickly look, if it wants to add up here, yeah, it's about 41,000 invested across all these different things. So companies like GEO Group, Realty Income, Stag Industrial, Starwood Property Trust, Cyrus One, WP Carey, Realty Income Corp. And so, of course, some of these are challenged in the near future. Obviously, because of retail and everything being shut in at the moment. And so we did have a good call with Realty Income Corp, but basically that was 1Q, right? I mean, a lot of the shut-ins and basically people having to stay at home and lockdowns really started to get severely impacted the second half of March, beginning of April. And so I think Q2 for Realty Income Corp and a lot of other companies are going to be a lot more drastic than 1Q was. There might have been some, I guess, credit equity losses kind of built in for future quarters based off of people's predictions, because I think banks and real estate companies are starting to do that now, or CECL, but I'm not 100% sure on the regulations associated with that. But I do believe that the second quarter will be pretty tough. And I guess depending on what does actually happen with the economy, things can get a little bit better. But you can see just from looking at this, I mean, the gains that we have in the portfolio overall are relatively healthy, about 3,500. And so if you consider that, it's about 8% or so return in general. But then, of course, you have the dividend income of about 2,200 or so coming in every single year. So I do continue to contribute to these quite often. So this Realty Income Corp, the position here is 146 shares. I did buy about 100 of these shares last month. So that's why this position is only about 0.7% down overall. And so I think we'll continue to buy Realty Income Corp if it stays in the $50 or so range. Currently closed today at about $52. So if it does go below 50, I do think it's a decent buy, especially if you don't own it yet. If you do already own it, I think I would wait till the mid 45s. I think it's a good quality company, but the uncertainty is something to definitely consider. So also consider your exposure to real estate. Mine's currently sitting at about 15%, as I mentioned a little bit earlier, of the funds outside of my 401k. So if that's you, just double check, you know what I mean? So Stag Industrial is another one that I've kind of loaded up on, added another 50 shares or something like that over the past couple of weeks. And that's just based off the fact that it got back down to close to my cost basis. So I think my cost basis originally was like $20 or $22 or something like that. And so it was $21.18, my original cost basis. And then I added at, I don't know if that was 23 shares that I added or 21 shares, but anyway, lowered the cost basis or around the same cost basis to add those additional shares there. So you do see a discrepancy between the shares that I bought originally versus the shares now. That's just based off of the dividend reinvestment. So a lot of the increase in the gains here is from that dividend reinvestment, basically taking those dividends in kind and reinvesting them back into the business. So looks really good in terms of that. So back when this thing was climbing up into the mid 30s, actually, if we kind of scroll all the way to the right, got all the way up to 33. This thing was looking real nice, over 100% return, I think. And then, of course, if it goes back up to that with the additional 20 or so shares that we added, it'll look really nice. So Starwood Property actually ended up beating earnings as well. so far so good associated with that one. We're only down minorly on this one, and that's due to the reinvested dividend. So originally bought 50 shares at a cost basis of around 20 bucks, so about $1,000 investment, and then reinvested about 20 of those shares from the dividends that I received. So now I've been taking those dividends as of late, probably the past year and a half, and reinvesting them into other companies. But really wish right now that I was reinvesting those dividends, but I don't think it's going to pay anytime soon. But does pay a decent dividend, especially if you're looking at it that way. 14% at the moment, or about 9.5% overall. But just taking a quick drag to the right, so it did just pay me on April 15th here, but it only pays me about 33 bucks a year. So it's a relatively small position comparatively to when I first bought it. $1,000 was a big chunk of money. Now it's a smaller position that I never really added to. So Cyrus One was also something like that. So bought Cyrus One. I think it was like 4 years ago when I invested into my Roth IRA. I wanted to buy two companies. One was WP Carey and one was Cyrus One. So I bought both of those around the same time period. And both have been great companies to invest in. For those of you guys that don't know, WP Carey is a lot like Realty Income Corp. They do have a little bit more international exposure. So I would, if you're looking for more international UK, German real estate exposure, I would look at WP Carey. They're both do triple net leases, so you're kind of in the same business and you're probably exposed to the same potential losses in the upcoming quarters because it is retail. But if you're into more international exposure, I would check it out. But Cyrus One, this is a data state real estate investment trust, or sorry, a data center real estate investment trust. So think of cloud computing, Amazon, Microsoft, Facebook, financial companies all need to store their cloud servers somewhere. And so this company focuses specifically in like Northern Virginia, outside of major metropolitan cities in the United States as well as abroad in Europe, and tries to basically provide them with data storage houses that they can basically store their servers and everything for, you know, a fee, and also charge the real estate to store the servers there as well. So it's been a relatively good investment. Bought about 70 shares a couple years back, and so far so good with that. So can't complain with that. That one pays a pretty good dividend as well. The annual payout for Cyrus One's about 153 bucks. Owes up to like 400 bucks, which I'm ecstatic about because that ends up being, you know, close to 40 bucks every single month just from this one. And then if you include this one as well, you know, you get about $1 here. So it's about 18 bucks here, and then about $1 here. So if you combine it, it's about 19 bucks. Sorry, 18 bucks, 38 bucks. Is that 38 bucks a month? I don't know. I'm not good with quick math, but regardless, you know, it's a pretty good chunk of change of income that I'm getting from Realty Income. And then of course Stag is just under 20 bucks a month. I think this is about 17 or 18 bucks a month as well. It's a monthly dividend payer as well. So WP Carey is a quarterly payer, so this is paying about 80 bucks, 70, 80 bucks every single quarter. So nothing wrong associated with this one. If it wasn't in my Roth, I probably would have added to it when the price kind of came down a little bit. But unfortunately, because it is in my Roth, I'm limited to capital, and I didn't want to add more real estate into my taxable brokerage account. So did some investments in other things like regular C Corps in my individual brokerage account, but it is what it is. And then of course you could see the investments back in Fundrise and Cardone Capital again. So like I saw and like you see here earlier, it's around $2,200 to $2,300 in income coming from that specific part of the portfolio. Now, of course, this helps contribute to around close to $1,200 to $1,300 every single month that I'm getting from overall investment portfolio. That doesn't include anything like YouTube or Shopify income, which helps increase that by a decent bit as well. But specifically from invested dividend income or distributions from real estate, it's around $2,200, and then I guess the remaining from dividend income or distributions from partnerships is around $1,200 to $1,300 a month. Hoping to get this bad boy closer to the $13,500 or so every single month, or sorry, every single year plus. So 2020, the goal was 14,000. Due to some dividend cuts, like obviously Disney, Shell, reduction of the dividend, and GM, which was very small, like 20 bucks or so for the year. Um, that obviously puts a dent in that. We were looking like we were going to be on track, but of course that Shell dividend cut hurt a good bit. I have about 170 something shares of Shell, and then of course that yields about 94 cents every single share. So that cut the dividend pretty significantly for me. I think it was about 600, 700 bucks for the year. So that puts a damper on things. But if you look at specifically 2021, definitely going to meet my goal. But the goal was to hit $14,000 in income in 2020. Now we're about $750 off of that. Of course, Pepsi just raised the dividend as well. So there are some hopes out there that we can continue to increase. Maybe later on this year, companies will reinstate dividends and hopefully can capture some of those. But I think the deferrals of payments or dividends into, say, next year or anything like that is going to put a hindrance on my 2020 goals, but that's not going to discourage me. Because even though I might miss it by, say, $750, that's way less than 10% of the goal, and I'm not going to throw away 90% of the goal just because I missed it by, say, 10% or less. Obviously, 1,000 out of, say, 1,300 is way less, and just from this, if there isn't any more cuts, we've already raised the dividend income from about 8,500 last year in 2019 to about 13,000 this year. So the goal is still showing, and the objectives are still showing through, even though there were some cuts. But I believe in the long term, when companies get and turn back around, things will return back to normal. So appreciate everybody joining me for this one. It's been a lot of fun kind of sharing the entirety of the portfolio. I know there was about a week of time and additional contributions into the portfolio in between, and appreciate that we were kind of stair-stepping it to try to slim it down a little bit, but it ended up being about 3 larger videos than 1 big video. But hopefully it provides a little bit more detail, and hopefully provides you guys with a little bit more insight as to how I'm doing my investing. And that was one take. So I did mess up the intro once, so I will edit that one out. But other than that, everything else was one take, and I might have to edit some minor things like with entering passwords and stuff like that. But overall, I think it went really well. If you're interested in the spreadsheet, if you've made it this far, there's a link down in the description. Of course, if you're not part of it already, join our Facebook group, that's in the description, and join our WhatsApp group. And if you aren't in the WhatsApp group, just message me at on WhatsApp at 1-868-769-0511. And just message me that you want to join the WhatsApp group. If you message me with a normal message, I won't answer because I'm not going to pay international texting fees. So I currently live in a different country than the United States. So please message me via WhatsApp. I will talk to you guys on a separate video. I'm trying to think if there's anything else before I wrap this one up. Yeah, link in the description. If you guys want to book time with me or Kyle one-on-one, just look at the website. Make sure to let us know that you guys are interested. If you're curious about if we can help answer and help coach you and tutor you into getting started in investing, we can do our best. But so far we've sold about 300 of these sheets, and it seems like people are relatively happy with them. Had some minor feedback to help improve the sheet. And in fact, if you guys are still watching, I did come out with 1.04 of the tracker. So I did fix one of the for dividend cuts. So for like Shell and Boeing, how they recently did their cuts, it hopefully should update a little bit faster. It used to do some logic based off of the pay date. Obviously, that's going to take a lot longer of time than if you base things off of the announcement date. So what we did is we did the announcement date instead. And so hopefully things come out a little bit quicker for us, and they cut dividends a little bit quicker. So for example, Boeing for me is now showing up as 0. It took about a week and a half to 2 weeks. But part of that was obviously due to NASDAQ taking their time as well. I'm going to track how long it takes Pepsi to do the same, because Pepsi just announced a dividend increase. So couple times. It all depends on when NASDAQ kind of puts it up on the site. So if they do it in a day, it'll show up and pull it from the site in a day. But if it takes a couple days, very dependent on each company. So it's a very big company, maybe they'll do it quicker. If it's a smaller company. But anyway, that's up there for you guys. You guys have the link for that if you've already downloaded the Google Finance Sheet. So all right, guys, I'm going to cut it off here. I'm probably just dragging on and trying to jam too much stuff into this video. So I will edit this one up and put it up, and I'll talk to you guys on the next one. Cheers.